if 10 other ETF issuers all agree that Bitcoin is an asset class, right, it should be 10x to 100x bigger than it is right now.
And so my mental model for where we could go, I think we're going to go somewhere between $750,000 to $1 million in Bitcoin on the upside.
I'm assuming, Kathy, that you're going to hold to your Bitcoin forecast for, what is it, $1 million per coin by 2030. That still feels good to you?
Yes, and you can, sometimes you need to battle test.
So, you heard it from the experts. It's time to go all in, right? Max out the Visa, borrow from your dad's retirement, and buy as many calls on margin as possible. All it takes is an ETF, right? Not so fast. Listen, the Bitcoin ETF is necessary, but it's not sufficient to reach those eye-watering heights. For that, you need several converging catalysts that no one's talking about. And on today's video, Ben, Lily, Ray, JJ, and Cody break down the forces that will propel Bitcoin's price beyond what the ETF can do, including an obscure accounting change that will unlock ways of liquidity. When the average consumer will start demanding Bitcoin, the dollar price signaling a massive BTC pump, and the Bitcoin developments that could add rocket fuel to this pump. And stick around to the end to hear which Bitcoin price target is most likely to come true and when. Regardless of your Bitcoin exposure, you need to hear this. Let's get started.
When it comes to Bitcoin, trying to hit some of those price targets that seem extremely lofty, I kind of view, in terms of the macro environment, there's really one event that I'm sort of anticipating. And a lot of the reason for this anticipation is just kind of going through the literature that the US Federal Reserve has put out, the Bank of International Settlements, and even the IMF at some points, and even a lot of academics that put forward research to them as well, and a lot of those journal articles. And there's been a lot of discussion on liquidity in the Treasury market. And I would also like to dispel some of the myth that is sort of happening within the Treasury market, because they kind of play in with one another. And once this kind of gets rectified, I would anticipate that the market will have an absolute deluge in terms of the amount of capital liquidity that comes in the market that would propel more risk on assets like Bitcoin to kind of hit those insane targets as they feel right now. So to get into it, the first chart here had some members of the team go ahead and look up all of the US Treasury auctions for 2023. This includes all the various different terms. So these can be 4 weeks, 8 weeks, etc., all the way down to 30-year US Treasuries. And what we ended up looking at is the amount of bids that were placed. So if we look at the first chart here, we can see that there are bars, and it's the height of the bars that indicate how much money has been placed for these bonds at their different terms and durations at each auction. And then there's a shaded part there at the bottom. That amount indicates how much the US Treasury essentially accepted. So if there was a supply or a liquidity issue unfolding in the Treasury market, and there were to be what everyone kind of is shouting from the mountainside, is that a massive sell-off is happening, we wouldn't necessarily see this shaded area going sideways or even trending up, while the amount of bars overall trending up as well. And so what this indicates to us is there's a lot more demand coming into the Treasury market, and there's even more debt being sold into the market.
Ben, I just want to ask you a quick question on that. Where do you think this narrative is coming from that there's no demand for the treasuries? Is it based on data, or is it just a perception, perhaps, that the US dollar is doomed?
I think it just has a little bit of kind of misunderstanding when it comes to how yields work in the market. Because you go ahead, you pull up TLT, and that tends to be this index of what's going on with yields that are over 20 years in duration. So this is primarily a ETF that's composed of treasuries of 20 and 30 years with kind of durations in between there. And when it starts to sell off and decline, it really just means that yields are rising. And when we associate typical price charts on an asset and the price starts to drop, like TLT is doing, everyone starts to think that it's a sell-off. And that's not necessarily the case. What's happening here is if you want to go ahead and issue more debt, your rate of borrowing money is going to rise. And that's really all you have to remember. You know, the US government, the Treasury, is issuing a lot more debt. And as a result, yields will rise.
Right.
Now, if demand were to drop and the amount of debt that they're issuing remains steady, then you would see yield rise. And I would be worried that there is a bit of a sell-off taking place in the secondary markets. But because you see the amount of bids at auction rising alongside the amount of debt being issued, it's just simply not the case right now.
Okay. It's good to know the data is actually giving us a better understanding of the market rather than the narratives that someone may hear on X or Twitter. But walk us through this other chart that you have here, supply treasuries.
Definitely. So if you go to like chart 3 and chart 4, they're line charts, and it's similar story here, but this is called the cover to bid ratio. And the way that you calculate that is essentially from the previous chart, you had the big bar and then you had the shaded region. You're just taking those two numbers, dividing them with one another, and you end up with this chart right here. And it's really highlighting that the ratio in terms of demand is actually rising. So this cover to bid ratio, as it starts to trend higher, it just indicates that there's more demand taking place at these auctions. So it's really just a consistent story. And sometimes you can kind of miss some of the nuance here because you might have, let's say you have twice the amount of bids at auction than normal, and you issue out in terms of debt, more debt than you did at previous auction, and your cover to bid ratio could be the same, right? So that's why you have to look at both of these charts next to one another to really get the whole story. So to summarize kind of these 4 charts, like if you go to the next one, it's the longer duration for cover to bid ratio. As you can see, there's not much variance taking place. There's not like an insane amount of cause for alarm unfolding. So to summarize, like the 4 charts that you did see, you know, there's not a sell-off taking place. This is how the curve is starting to normalize over time. And it's really the Fed and the Treasury working together to really normalize that curve, normalize the rate market, and to allow the Fed to really accomplish some of the goals that they've set out to do.
So I want to ask that, walk us through why first of all, just explain, layman's terms, what exactly we mean by normalize the curve and why that impacts crypto, why we're talking about it on a crypto show.
Yeah, that's a good point. So when it comes to the Fed themselves, we've had rates very low for a long period of time. And then in late, I hope I get my dates right, late 2000, early 2023, I believe in March, I think my dates are wrong. Late 2021, early 2022, rates started to rise. There we go. And the rate at which that unfolded was historic, right? Rates never rose at the speed at which they did before. It was unprecedented. And what that caused was anybody that was holding bonds didn't want to hold longer duration, because if that bond is yielding like 1% and the Fed's already signaled that they plan to raise rates from say 1% to 2% or 2 to 2.5%, do you want to be earning 1% for the next 30 years, or do you want to earn 2.5% over the next 4 weeks? Give me the 4 weeks, because at the end of 4 weeks, they might have raised rates again. So I want that higher yield exposure. And so that's what unfolded. And as a result, the curve just got completely dislocated. The 4 weeks, 8 weeks were so much higher than the 10-year, the 20-year, and the 30-year. And so this dislocation meant that logic in the credit markets were nowhere to be found, right? Money if you want to lock it up and borrow money for 1 month versus 30 years, right? Your 30-year borrowing rate should be much higher, all else equal. And that's not what we saw, right? So capital markets essentially need that bit of logic to go ahead and do what it does best, which is build businesses, borrow money, and try to create more productivity, more value off of that borrowed money. So as far as what it means for crypto, a lot of this has to do with money starting to get tied up into a lot of yield. And this is kind of what I want to hit on today, which is there is a little bit of stress in terms of liquidity in the treasury markets, but it's not really showcasing itself, right? It's requiring primary dealers and brokers to hold a lot of value of those treasuries on their balance sheet. And they have this ratio, the SLR ratio, supplemental leverage ratio, I believe it's called. And they have to hold cash on hand because treasuries have a bit of risk associated with them. And when it comes to other markets, for example, the Bank of International Settlements through what's, I think, the Basel III framework, that risk rating is 0, right? You hold a treasury, there's no risk on your balance sheet, so you don't need to hold capital essentially as a backstop of liquidity. But when it comes to the US, that is a bit different. And it didn't always exist. They actually took it down, I think in 2020 for a little bit. It got reinstated. And so the ratio exists. So these primary dealers and brokers, which handle like 50% of trade volume for treasuries in the market, they have to have capital on their balance sheet. And so it ties up liquidity. There have been discussions. There were some papers from the symposium, Jackson Hole Symposium, earlier this year alluding to this ratio and possibly getting rid of it to really help free up some of the balance sheet for primary dealers and brokers. If that happens, because I do think it will happen. Like, I don't think it's a matter of if, it's a matter of when. Because if you look at the treasury market, it doesn't have liquidity issues. It's more likely happening elsewhere. There's only so much liquidity. And if it's not in the treasury market in terms of stress, it's got to be happening in the corporate market or the real estate market. And when those stresses and those fractures get big enough and the market responds and you do see the sell-off, like, to me, that's when this ratio is going to be changed. They're going to free up liquidity on these balance sheets, and it's going to essentially signal to the market that it's risk on time. And that, as we mentioned earlier, when it comes to reaching these higher prices for Bitcoin and cryptocurrency assets, you sort of need that type of macro event, these reduction of likely good regulations in general, but they're going to free up capital, so to speak, in the market.
So just to summarize here, make sure I've got this from a layman's point of view, the banks have the capital, well, they have the capital already. It's sitting in treasuries with an accounting change or regulatory change that would now allow them to lend money or inject liquidity into multiple markets, which would suggest that we now have a risk on. So really, you have this change that happens in the market, but it's not the Fed making a change. It's not doing any kind of QE. We're not seeing more money being printed, so to speak. It's really an accounting shift that would inject almost overnight. You could see an injection of liquidity.
Absolutely. And it's more of like a footnote item, right? Those are one of those events where, the mainstream media is probably not going to really talk about it. And so your normal everyday investor is probably not going to realize what just took place. So it's going to be hitting QE. And really, I don't want to really get too much into it here. Maybe we could spend another time talking about it. But what this does, if you change that requirement where it's 0%, you really change the game of what these banks are already alluding to, which is issuing tokens, paired up with that capital on their balance sheet. Like we see USDC by Circle in their stable coin, they have treasuries that are backing all of these stable coins. And so they're able to earn 5% on all of those treasuries that they're just taking custody of. And these these banks are already jealous of it. They understand that business model is very lucrative. You see what Tether's doing. You've seen their quarterly profits. What this ratio change will do is allow those banks, which they're already issuing, like JP Morgan, for instance, has JPM coin, and they want to issue these deposit tokens, relative to these treasuries that are going to be sitting on their balance sheet. So now everybody here, we can start transacting with these stable coins. They can hold the treasuries. They don't have to hold any additional capital on their balance sheet with these treasuries, and they can go ahead and earn the yield. And to me, this is where the financial system at large is going. It just needs a sort of event to help get us closer to where their end game essentially is.
All right, last question on this topic of what could unleash just waves and waves of liquidity. Is there one or two events that you're looking at specifically that you think would actually turn the key and allow this change to happen?
I would imagine a mortgage-backed security sell-off would be one such event that will cause this to unfold. Another one would be some issues starting to rise in the corporate debt market with some of the not necessarily zombie corporations, but these really massive corporations that have essentially become so too big to fail in a way. And if they can't issue debt, that's going to be a bit of an issue. So they're going to need to attract some buyers. So those two markets, I would say, right. You see major sell-offs happening. I would be looking out for this on the headlines.
Okay. So look for the maximum amount of pain at the macro level, and look for this small itsy bitsy change that probably won't even be reported to unlock just waves of liquidity we haven't seen in years. All right. Okay, Ray, I want to turn it over to you. We just heard from Ben what he's looking to unlock waves of liquidity. I want to get from your perspective what you think could be a catalyst that would really, beyond the ETF, could really help to drive the price even higher. And maybe it's something macro, maybe it's something more related to crypto, things that you're looking at.
So prior to I guess you could say the institutionalization of crypto, retail investors played a large role in Bitcoin's kind of price discovery and its market cycles. This is when Bitcoin was a smaller market cap asset, when there were fewer exchanges to trade it on, when a large amount of supply was held within whale wallets and miners still exerted huge sway over Bitcoin pricing. And those things have changed. In the last cycle, we saw a combination of retail investors who are quarantined at home, having disposable extra income and lovely stimulus checks from President Trump, kind of boosting sentiment for going out and investing in risk assets and learning about crypto and stocks and all that, alongside heavy inflows coming from venture capitalists and institutional investors who could like traverse that easy bridge into crypto and also had access to low interest rate free money, basically. So it's going to be different this time around. Data from Fred shows that your average retail investor, the average American, is borderline broke in 2023, and that could be set to worsen in 2024. So data from Fred shows household debt service payments rising back toward like a 15-year high. We see the delinquency.
Right. Yeah, could you just walk us through for the audience what this chart says, and then obviously what you're taking from it?
So delinquency rate on credit cards and personal loans, meaning people who are like 30 days behind on their payments, that's rising. I think it's kind of a mean reversion because we simply see post-COVID stimulus dried up and people's kind of like financial illiteracy and living beyond their means or wages not really allowing people to live as well as they desire. We see that kind of coming back to trend. So basically, if you look at the delinquency rate on personal loans, credit cards, and auto loans, we are beginning to see signs of distress and that people have less disposable income. Another chart, household debt service payments as percentage of disposable personal income, shows that people are spending more and more of their monthly income on rent or on their mortgage. a trend which was broken during the COVID era also. So to me, that also kind of looks just like a return to norm, right? Like COVID was the kind of outlier that allowed people to save up a lot of extra money and enjoy life more. So I don't necessarily think that these metrics are screaming like, oh my God, they're going toward new all-time highs, and this is a sign of a hard landing and a deep recession and soaring unemployment, and that the auto industry and that banks will need bailouts, and that toxic mortgage debt is going to lead to the housing bubble to explode. I don't think that that is the case, but the fact that these metrics are beginning to rise toward decade highs again, when you combine that with the fact that the Fed is struggling to make inflation unsticky and get inflation down to its 2% target, and we have this kind of national debt bomb in the background, and we all know what the macro headwinds are, which face kind of the economy and your average consumer, that's the cause for concern, right? It's like if your A1C is high, perhaps you're pre-diabetic, but you don't have full-blown diabetes. But if certain lifestyle changes aren't made, or if certain trends with that person don't change, like their diet, managing their sugar, becoming more active, dropping weight, if you don't begin to kind of like cancel out any of these other factors that are contributing to you having high A1C, then eventually you become fully diabetic, and that's a big problem. So that's the red flag for me with these kind of metrics that we're looking at.
Yeah, and I do want to bring up, producers, could you bring up U.S. government debt service payments? Because, you know, I think you do a nice job here, Ray, of trying to give people to have a level-headed view of not, you know, when they hear everything's just going to implode, they don't just go immediately to sell all, you know, I'm going to hide out some kind of bunker. At the same time, when you look at the data, this one coming from Fidelity, it's a pretty shocking story on where debt service is gone. And where it appears to just continue to be up and to the right. And
yeah,
I think
concerning.
The background agrees.
Yeah, the dog agrees, rightfully so. So it's concerning. The debt burden is above 33 trillion, and the Congressional Budget Office, or CBO, estimates that U.S. debt as a share of GDP is going to set a new record this decade. It's going to climb from 100% to 107%. The estimate is that it's on track to hit 181% by 2053, which is unreal. So what's not sustainable here is that it's going to bankrupt the nation or its future children. And these payments already outpace federal spending on youth education. And in 4 years, according to a smart person, Maya McGinnis, president of the Committee for Responsible Federal Budget, she says it's going to top defense spending. So to tie this all back to Bitcoin, if retail investors are not going to be they're not having the fat wallets and disposable income to come and be the euphoric investor that pushes all crypto prices to new all-time highs, well, it's got to be something else. And we all know that the ETF is kind of that gateway that creates that new liquidity and allows everyone to invest in Bitcoin safely and send its price to the moon. But that still involves retail investors to a certain extent. And the ETF's only half the story. So my view is that there's going to be an ideological shift among the American consumer, or even the global consumer, or the global saver, right? Like there's different cohorts of people that find Bitcoin attractive for a variety of reasons. And the realization is going to be that the Fed, here's your signal, when the Fed kind of capitulates on inflation by revising what its targets are, when some of the things Ben talks about as being ways to unlock liquidity through national debt and through treasuries, when those things happen, when people realize that there's no solution to dollar devaluation, right? And when quarterly earnings begin to take a hit, and when the Fed begins to pull back rates and cut them, yet inflation continues to impact people on the daily, then the appeal of a supply capped, low emission, portfolio protecting asset such as Bitcoin that's when it becomes more attractive. So the big tell is to look for all of these metrics continuing to push into new extremes and seeing that the Fed is not able to meet any of its objectives and inflation continues to hurt people and the 60-40 portfolio is no longer putting people on track for a path to retirement. When people realize that, there will be an ideological shift which makes assets like Bitcoin attractive. And I think that's when you'll begin to see more sustained inflows into Bitcoin from the retail side. And who's going to define that narrative? The same people that are having the ETFs approved will be pushing and peddling that narrative. And I think it'll sell and it'll be attractive. And then your standard, like the guys that are on CNBC, Cavuto, and all those other guys, Kramer, all the talking heads in the room, will also be pushing Bitcoin also. So I think that plays a role. But the ideological pivot among the American consumer, a certain cohort of them, I think that's the true catalyst for when Bitcoin finally begins to get really sticky and hold on to some of these like higher projection gains that analysts are making.
Got it. I want to ask, so it's really about a narrative shift that has multiple inputs as you just described them, from the debt, from the understanding that inflation's not going to go away, it's just being ignored by revising its target, and then also realizing that the debt or the way in which we have to operate our financial system is no longer tenable. What is your perspective on timing here? Because I think for a lot of the people in the audience, they can be very much looking at the next 1 to 2 years. Narrative shifts can happen very quickly at times, right? If there's a single event that happens, or they can take as long as a decade. So how do you think about that question of the timing for that narrative shift?
That's a great question. I personally think it happens over the next 2 years. So simply because with the impending ETF approval, with the Fed kind of coming to the end of its timeline for its interest rate hiking regime, its terminal rate being reached and soon exceeded, the national debt of all this like REITs and every other type of debt that was financed at 0 or 1% needing to be rolled over in 2024, 2025, 2026, like everything macro and Federal Reserve related and crypto related becomes to come to a head. And if the ETF's approved, then I really do think you'll see the Finks and all those other guys kind of peddling this narrative of digital gold, low emissions, supply capped, portable, protects against dollar devaluation, helps you get that extra 1, 2, 3, 4% percentage points on your compound interest for your end of year portfolio goals. Like they're the ones that are going to sell that content to people. And with us Americans being kind of financially illiterate, that I think that's the compelling narrative that will convince them, or even unknowingly they'll be shoveled into Bitcoin, as JJ mentioned last time.
Yeah. It's a awkward picture of it, but it feels like that's going to happen. Okay, so I like that. So you're saying narrative shift. You're really looking at this over the next 2 years. You've identified a few different points you can start to see as you're saying the brokers that are starting to push these products are really going to be hitting on this messaging. Anything else that you'd want to say before we go on and talk to JJ next, just from a narrative perspective?
I think if that's successful, what you just described, so if we begin to get more investors onboarded into Bitcoin through an ETF, then, when you look at the gold ETF and how it just went ballistic after that first year, then I think you begin to really explore some of the, not just the higher price targets, but the ideology of what Bitcoin can do on a global scale. That's when I think you have the foundations being laid now. And when you have that first 1 or 2 layer of institutional investor, locking in investment through the ETF, then you can really kind of have a strong foundation, and all the ideas of what Bitcoin can do and is meant to stand for can kind of blossom and grow.
All right. Well, I like that perspective. Again, another thing to consider about the actual mechanics of needing liquidity, but also the psychological mindset that's going to change and help us drive beyond the ETF. Okay, well, we're going to come to JJ next and get more of his perspective on what he thinks is going to happen to propel us beyond what the ETF can do alone. After that, we are going to be coming back and talking about 3 specific projects or events that are happening in Bitcoin that could also be some of those catalysts. You're not going to want to miss that. And we're going to be wrapping it up with questions about which of these price targets the team thinks are most valid. So there's still a lot more to come to, but JJ, I want to kick it off with you. You just heard something about liquidity. You just talked about narrative. What's your perspective on what's going to be the catalyst to move us beyond these price targets that the ETF can deliver?
Yeah, some good insights there, which really syncs up with my theory, which I just try to keep it as simple as possible. You know, I'm not a gigabrain like these guys, macro analysts, but what I do look at is DXY. And I think everything that Ben and Ray were discussing, ultimately, the way that those catalysts show themselves is in the price of DXY. So when there's times if the Fed has to rush to action, increase liquidity, allow banks to access the liquidity on their balance sheet through bonds or whatever that may be, anytime that there's extra liquidity added into the market, we see DXY sink. And a falling DXY is one of the most bullish catalysts for Bitcoin, as we see here on the DXY risk rating chart. At times when DXY is turning hot, as it is right now, this registers a red rating, which tells us that there's higher or elevated risk in DXY. So what I would really need to see to go all in bullish would be this, obviously, to turn green. So that would signal that DXY is kind of in a formal bear market, and that really gives the green light for risk. And
JJ, if I can you just give us a summary for those who are unfamiliar with the Dixie risk rating? Can you just go over that again? What exactly we're seeing on this chart?
Yep. So this is our proprietary in-house metric that we made, and it just kind of compiles a bunch of different technical factors, measures them DXY, and it gives us a strength reading. So it tells us whether it's technically strong or technically weak. At times when DXY is technically weak, we see a stronger Bitcoin and vice versa. So you see on these green dots, obviously throughout 2020, following COVID, we saw the dollar devalued, right? So that allowed this accumulation pattern here in the summer of 2020, where you just had a green light to buy as much Bitcoin as you wanted at around the 10K level. And then we see how that played out throughout the course of the year. DXY remained weak. And it wasn't until we reached those upper bounds around 60K that the market started telling us, hey, this is a bit risky here. And then once it did flip risky, obviously you missed that double top in 2021. But if you would have de-risked at 60K in March 2021, you'd have been sitting in good shape, and you could have bought the bottom following the FTX collapse when this turned green again in late 2022. So this is just kind of our way to gauge liquidity and dollar strength in the market, and that correlates to Bitcoin almost 100% of the time, not on a day-to-day basis, but over longer time frames. The stronger the dollar is, the weaker Bitcoin will be, and the weaker the dollar is, the stronger Bitcoin will be. So what I really want to see is this turn green, and that would be a green light to add a lot of risk into Bitcoin, in my opinion.
Okay. So you're really just looking at, as you said, one metric, which is what is the dollar doing? We talked about the fact that you could have an unlock in terms of liquidity that could perhaps, I guess in your perspective, that would actually weaken the dollar and give you more signal to actually be buying into Bitcoin. Is that right?
Yeah. If you think about it, what is liquidity, right? It's essentially devaluation, and you see devaluation when DXY drops. Mm-hmm. So this is just kind of a very simple way to, there's so many complicated things that are beyond my pay grade, quite honestly, things that Ben was discussing, Ray. So how do I simplify that and look at this in an actionable way where I could say, okay, this is happening. Now is my time to act. Here's the window. And obviously if that syncs, I have daily conversations with Ben and Ray. So if that's following along lines with what they're seeing as well, that's some powerful confluence. And I can use that to make educated decisions on risk.
Okay. Well, you have another chart here. Did you want to pull that up and walk through some other data?
Yeah, this is an interesting one I wrote about in the summer. So what we see with the dollar on its monthly chart is anytime it loses the 50 RSI mark, I believe currently it's hovering around there. It's currently at 58.73 on its monthly chart there on terms of RSI. So what we would really need to see is that fall below 50. And you could see that this leads to strong down patterns in DXY over time. So if you just kind of overlaid your mouse there and measured it against RSI, you see when it falls below 50, that's when you see some of the strongest sell-offs in the dollar of all time. So if the dollar were to lose that line on the monthly chart, I mean, there's no telling where this thing could bottom. It could go to the low 70s, take out 2008 lows. Who knows? But I wouldn't want to be holding long positions in dollar if that happened. I would want to be denominating my wealth in Bitcoin. So that's kind of the line in the sand. We're not there yet. We might not get there, but that's one of the definitive things I look at in terms of, okay, if I'm looking at this over the course of a year or longer time frame, not the day-to-day stuff, that's what I want to see happen. I want to see the dollar breakdown, and that is the green light. And then you could have the Larry Finks go and sell your bags to people's retirement portfolio for you. They'll do all the heavy lifting.
Yeah, I was gonna say, what does that look like? Give me the scenario where the dollar just absolutely crashes and Bitcoin just rips.
I imagine that's some pairing of what Ben discussed and Ray. So some sort of financial distress. We know the market's kind of an opaque box, right? In legacy markets, we don't know what kind of risks banks are hiding. Sooner or later, these things blow up. What happens when they blow up? The Fed injects liquidity. We know the playbook, right? So when that happens, and the next stimulus will almost assuredly be larger than COVID, right? In terms of money printing, the amount of devaluation that happens in the dollar, I think it's kind of setting up for a blow off or a blowout bottom in 2024 or 2025. So that's something I'm monitoring as like we see legacy markets come under stress. Bitcoin will probably experience some downside, which would give a good buying opportunity in that event, because we know what happens next. When the dollar gets too strong, they have to devalue it. And the next time they devalue it, it will likely be beyond anything we've ever seen before.
Okay. So you really, in the next couple of years, kind of similar to what Ray shared in terms of timeline, that's what you're monitoring. That's what your expectation is, your base case, if you will.
Yep. And then you'll see kind of all those narratives start spinning about flight to safety, all those different things, hedge against inflation. Because if they devalue the dollar to that level, I mean, we're struggling with inflation now and the dollar's strong. So what happens when it goes to 70? You can only imagine, right? So,
right.
And to Ray's point, sadly, by the time retail needs Bitcoin, they will probably be priced out of the market due to all the constraints he was mentioning there.
Sure. Yeah. Well, let's hope it doesn't come to that, but I think there's a good chance it will. Anything else before we move on to Cody?
That's all from me. Keeping it simple.
Okay. All right. So there you have it. We've got a way of looking at the dollar to give you a sense of when call it the Bitcoin Kraken is unleashed. We've talked about the narrative change that you'll see happening and being pushed by some of the largest institutions like BlackRock. And of course, we have the accounting change, which will unleash just floods of liquidity. Now we're going to transition. We're going to talk specifically about projects that could impact the Bitcoin network, the ecosystem, and whether or not those should be looked at as price catalysts or perhaps not. Maybe they're just non-events. And we got three that, Cody, you're looking at, and we're going to do it in the like it or spike it mode as we always do. Cody, you ready?
Yeah, let's do it.
All right, exciting. Okay, so the first one we have here, Coinbase announces they are integrating network for Bitcoin transactions. Like it or spike it?
I have to spike it.
Oh, I know for any of the Bitcoin supporters out there, they're not going to be too happy to hear about that. Tell us, why are you spiking it?
Yeah, probably not. To be fair, I really like Lightning as a technology. I think it's great. Just a quick recap. Lightning Network is like a sort of layer 2 slapped on Bitcoin, and it's used for payments. So the way it works is you open a channel between two nodes that are on the Bitcoin network, and then you can transfer Bitcoin through that channel, and that sits outside of the Bitcoin network. So that's like a peer-to-peer system to send Bitcoin for like really cheap actually and fast, and it's very scalable. Basically any nodes that want to do it like can open a channel and like send Bitcoin through this Lightning network. As I said, it's really cheap. The median channel has a fee of I believe 54 parts per million. Just to throw some numbers, that's like on a $1,000 transfer, you would pay 5 cents. So yeah, as I said, if you compare it with like normal Bitcoin transactions, it's really cheap. Even if if we can go to the image from the Binance transfers, you can compare. Even if you want to do a transfer from Binance, you can send Bitcoin. That would cost you $1.6. If you use Lightning Network, that would cost you what, 2.6 cents. Like that's nothing at all. So that's great.
It seems like
All of
great
that is great.
innovation. Yeah, low
Yeah.
prices. Why did you spike it?
Because it just hasn't found product market fit. People don't really want to use it. Like if you look at how many channels there are and like the capacity that they have is just minimal. Right now there's around 64,000 lightning nodes. If we can move to the next image, 64,000 nodes with a capacity of 5,000 Bitcoin. That's really not much at all. And it's also about like where they sit. A third of it's in the US, 13% in Germany, and 10% in Canada and France each. And they don't really see much much volume through them.
Cody,
And
if I
yeah.
can you just explain what exactly we're looking at here on the chart?
Yeah, so we're looking at in what's the name in yellow. You have the number of channels that are open. So as I said, if you want to use the Lightning Network, you need to run a Bitcoin node, or you need to use a channel that another Bitcoin node has open. And yeah, these channels are open between two nodes. It sits outside of the Bitcoin network, and that channel is used to send the Bitcoin. So just imagine it as a highway between two nodes that are part of the Bitcoin network. And then yeah, you take your Bitcoin outside of the Bitcoin network, you send it through that channel. The other node receives the Bitcoin, and when the transaction is over, you close the channel, and everyone agrees that like the second node has the Bitcoin, but nobody in the Bitcoin network really has to sign off or even see what is happening on that like outside channel. That's why it's so cheap and fast, because like you don't really have to have consensus for all that. You just need to sign off on like, oh, who is the end user that has the Bitcoin, right? And then on, I'm gonna call it red, you have the capacity of all those channels. I think it's since around like 5,000 Bitcoin. That's like, if like the total volume that you could transact through those channels, 5,000 Bitcoin, yes, it's a lot of money, but like if you are talking about like something that people expect it to be like I don't know, like global payment system, like it's really not there. It hasn't really found the success that people were hoping for, and it's been going on for years. So if it hasn't found it by now, like it's probably not going to find it anytime soon.
Okay, so it's not really a catalyst, even though there may be some of the narrative floating around. So that's why you spiked it.
If things change, like if things change, I'll change my opinion. But like as it stands right now, it doesn't look too great.
Okay, fair enough. We call it like we see it. We don't want to sugarcoat it. All right, let's move on to the next one. We got Bitcoin developer Paul Struck makes a proposal to implement drive chains on Bitcoin. Like it or spike it?
Like it.
Well, there we go. There's some optimism. So this could potentially be have a huge impact on Bitcoin. Tell us why.
Yeah, it could. This is similar to Lightning Network, but like as in the Lightning Network, you have like sidechains or like layer 2s sitting outside of the Bitcoin network. So any node that wanna be part of the drive chain or sidechain would kind of like open up a new network that would be sitting outside of the Bitcoin network and just enable any kind of functionality they want to enable. So you could have smart contracts like on Ethereum, you could have like a more privacy-oriented network, and all this is sitting outside of Bitcoin network. So any nodes that don't want to participate, they don't have to participate on that. They won't even see what's going on. It's only about like if they want to get that Bitcoin off the sidechain back onto a Bitcoin network, that would see it again, but like it wouldn't have an effect on the Bitcoin network as a whole. Right now, we're still like in the let's debate phase. There's two propositions, BIP 300 and 301, that would need to pass for this to happen, and like there's a lot of people within the Bitcoin space that are against it because they see it as like a sort of like grift and like that would just enable shitcoining. But I would say it's it's a really good opportunity for Bitcoin to like kind of take back the reins. Like Bitcoin as it stands is great, but I think like when it comes to furthering the development of the blockchain technology, it has like it hasn't taken the reins for a while. Like it's been quite ossified, and I think this would then enable an avenue for Bitcoin to again be a place where development happen, but without the possibility of damaging the Bitcoin network, which I don't think anyone wants. So yeah, that's why I'm excited about it, but it's very early days, so we have to wait and see.
You have to wait and see. If you had to give a probability right now with everything you know, what do you think the chances are of this getting passed? 25, 50, 75, 100%, 0?
And I genuinely don't know. I'm gonna like
Okay.
I would I would be
I put
lying
you
if
on
I
the
said
spot for a
anything.
reason. It's okay to say you don't know. If you want to deflect, we'll come back to that once we see some more movement here. All right, let's move on to the last one we've got here. Ordinals inscription spending falls to lowest since they appeared. Like it or spike it.
Spike it.
Gotta say, a little disappointing here, ending on a sour note. But walk us through what the inscriptions are and what you're seeing in terms of the trend here.
Let me be clear. Like I'm characterizing ordinals where they are right now. I think it can be a great technology, like a great narrative in the future. But like, okay, let's take it back a sec. What are ordinals? So ordinals are kind of like NFTs on Bitcoin. There was this upgrade called Taproot, which didn't have anything to do with ordinals or NFTs or anything. It was just aimed to improve the efficiency of the network. But Bitcoin Dev found out that you can actually inscribe satoshis, and a satoshi is like the cents of a Bitcoin. Like I think it's 10 to the minus 8 or 9. I don't know. I'm not exactly sure enough. But like it's just a way of dividing one Bitcoin, right? This guy found out you can inscribe messages on a Satoshi, which kind of makes it a unique Satoshi, aka an NFT if you want. And it had a lot of success in the beginning. So far, there have been like 35 million Satoshis inscribed, and it gathered a lot of fees. I think 58 million USD or 202,000 BTC. And it saw a peak in April, May. I think if we look at the images, we'll see. Next one, maybe we see that peak in April and May, which was weeks of like plus 10 million USD in fees. And that died down. It saw a little bit of a respite in September where we saw like 1.5 million weeks in fees. But now it's quite dead. Like we see weeks of like less than 100K fees spent. We see volumes of the highest market cap collections at less than $1,000. Ordia, which is the highest market cap collection, sitting at 60 million or something. It had a daily volume of less like $4,000. It's just not great. Like I really like the kind of like the fun that people were having with ordinals, and I think it can come back. And I think you could see the same that happened with Ethereum, right? Like we had like with NFTs, we had like a discovery phase with CryptoKitties and the like, and like kind of a lot of people saw it as a fad and like maybe something that like wouldn't amount to anything. And yeah, they see some success, but not much. But then later on, with like the second like renaissance, let's call it that, we saw like a success that no one had, like no one was expecting, right? Like, so I think this could happen again with Bitcoin. I know that a lot of Bitcoin people that like hadn't been really excited about the developments on the chain got really excited about it and are working on things related to ordinals. But right now it's quite dead, the market for ordinals.
So
hopefully
the
this
market's
changes.
dead. It's not going to be a catalyst in the near term, at least as it is. It has to change.
Yeah.
but in your mind, that if it can change and create more interest and more opportunity, this could be a catalyst at some point.
Absolutely. And like at the end of the day, people are in crypto to make money and have fun, right? And I think this ticks off those two. And also, it could help with one of the biggest drawbacks or like pain points in Bitcoin, which is that when Satoshi started Bitcoin, he envisaged that in the future, like you wouldn't need to mint any new Bitcoin because like the fees would cover would be enough for the miners to secure the chain. But right now, the fees are not nearly enough for any to entice anyone to secure the chain, right? But if you see ordinals picking up and you see those fees ticking back up again, that could change in a heartbeat. And maybe this is maybe NFTs are like the thing you need for Bitcoin to be profitable in a sense, or like for people for miners to be profitable when mining or like securing the network, even if no new Bitcoin is created.
Okay. All right. So a little bit of hope thrown in with the fact that unfortunately they're not delivering that today, but there's the possibility, and with the twofer of coming back and helping out with the security budget. Of course, I think Drive Chains would do that as well, as I understand the proposals. But all right. So for those listening, the audience asking, why do we recover those? Because all of those projects could have a massive impact if implemented, especially if we talk about some of these timelines over the next couple of years, and lead to the availability of the network and maybe the depth it can hold for finance and even fun, as Cody likes to point out, which gets us back to the question of the hour of today, which is, we started off this conversation talking about these price predictions. I'm going to ask each of you guys which price prediction is most accurate. What we had from Cathie Woods, what we had from Arthur Hayes, Michael Saylor, or someone else. And just to recap what we have here, Michael Saylor said Bitcoin ETF will 10 to 100x the price of Bitcoin at the time. That would put price at 250,000 to 2.5 million. Of course, no date given. Arthur Hayes said Bitcoin to 750,000 to $1 million by 2026. And Cathie Wood, well, she's a little bit more conservative. She's saying Bitcoin to 1 million by 2030. All right, I want to open it up. I'm going to go around the horn here. JJ, I'm going to start with you. Of those price predictions, which do you think is the most accurate, or someone else more accurate?
Team Sailor, baby. I go with him. Do I think it's realistic? Not in my mind, but there's been things I just noticed that the market tends to think they're smarter than Sailor, and today's evidence that they're not, right? And that trade of shorting MicroStrategies quickly become a widowmaker. So my days of trying to fade Sailor are past. Team Sailor. I agree with his price targets from now on.
Team Sailor. Okay, so we're looking. Are you saying 250 or 2.5?
Let's round it in the middle. So what is that? I don't even
somewhere
know. 1.2.
There we go.
1.2 million. Yeah, 1.2 million. Book it.
Okay. All right. There we have from JJ. Ray, I want to ask you the same question. Which of these?
I'm going to go with I'll go with Sailor because it's the lowest number. I don't like Bitcoin price projections, and smarter people are better able to formulate exactly how price gets to that high. I will say Arthur Hayes's interview that he did with Tom Bilyeu like 3 weeks ago was incredible. He mapped out why, how, when Bitcoin gets to 750K to a million per coin, or it might have been 2 million per coin. And, like everything we talk about, he laid out in 3 hours with the greatest detail possible. So while I'd be happy to see price get to that number, it's just out of my brain. So I'll go with Sailor at 250K.
All right. We got two for Sailor right now. Very good explanation, Ray. Ben Lilly, which of these three or someone else has the best price target?
Oh, I'm going to say nobody. But if I'm going to have to say one, it would have to be Cathie Wood, because she puts 2030 as part of the caveat of her price prediction. And really the reason here is even Sailor's lower prediction of 250,000. Like, I don't think we get there this cycle. We look at how much price changed from the previous, say, 2017 cycle, it was around 20,000, and then the most recent one was just a hair below 70,000. Like, are we going to get that multiple again? I don't think so. We're all looking at the ETF as this potential catalyst, and I think it takes a lot longer for that to unfold and translate into price action, and that's where Kathy Wood's prediction, I think, starts to come into play here within the cycle, where we see a lot of capital start flowing in through various entities that have now set up all these channels for the ETF to be bought. And if I had to go ahead and almost meme this next cycle as far as what price prediction could be, I literally would just say 169420, because that just seems to be what the crypto community almost wants. It's the magnet, to make all memes that they produce a reality.
All right. Well, we got a maggot coming on the board. Cody, I'm going to give you the final word. Which of these price predictions do you think is most accurate, or is it someone else?
Yeah, I'll have to go with Taylor as well. He seems, for I don't know how, but like he's the most conservative of the bunch. So I think, yeah, 250K is quite reasonable. Maybe not this cycle, but like by the end of the decade for sure.
Okay. All right. So I think I heard it. We had 3 for Michael, 1 for Kathy. But we also had a bonus there with Arthur Hayes getting a shout out for having a great articulation of his vision, but just almost something we couldn't even buy into so much. All right. Well, that's going to do it for this week's episode. What we wanted to do today was give you things to be thinking about and to be on the lookout for that are going to be well beyond the ETF. Everyone's going to be talking about the ETF. That is important. What we're talking about here, this is going to be the added fuel that's going to move Bitcoin to that next level that pretty much everyone wants it to go. And for the reasons laid out today, from unlocking liquidity to narrative changes to a weaker dollar, and then these projects that Cody talked about, these are all the catalysts that will start to come together that you can be looking for and giving you some perspective as you look to invest. So with that, we're going to wrap up. I want to thank Ray and Ben Lilly and JJ and Cody for coming on today. And I look forward to having them back to talk about our next topic, whenever that may be. For all you out there, have some dry powder. Be ready for those opportunities, so when they come, you can hit them. This is Marconi White signing off. If you found this content informative, JJ is putting together a deep dive trading for crypto options that goes into even more detail on what you just heard. So like and subscribe to the channel so you can watch it as soon as it comes out. And thanks for listening, sharing, and commenting on the latest video.